I'm Professor Rabesekar. Let's look at Intergroup Transactions. We're going to look at intergroup transactions related to services and intergroup transactions relating to inventory. On inventory, we're going to look at inventory that has been sold during the current period and entirely held at the end of the reporting period, inventory that has been transacted during the current period and partially held at end of the reporting period, and then inventory that has been transacted during the previous period and in the current period it has been sold out. So looking at intergroup transactions, it's a buy and sell transaction between two entities within the group, and any sales and cost of goods sold has to be eliminated 100% regardless of the ownership. What we eliminate are the unrealized gains or losses and the overvaluation or undervaluation of the asset, and we eliminate that in full. The first is the service transactions. So there's one entity that receives revenue and the other entity that incurs an expense. We're saying that it's an invalid transaction and we need to reverse that. So we debit revenue and credit expense. For example, we have an entity that has paid 3 million for management fees, and the other entity has received as income management fees. So when we look at general journal entries, we see debit cash and revenue credit on the parent entity, and on the subsidiary debit fee expense and credit cash in the other entity. We can combine the two general journal entries and we come up with debit expense and credit revenue 3 and 3, and consolidation entry is to eliminate this entry, so we debit revenue and credit expense. We are now going to look at intergroup inventory transactions during the current period and entirely held at end of the period. So what we need to realize is that one entity made a gain and that has to be reversed, and the other entity has received an overvalued inventory. That overvaluation has to be reversed. When we decrease the overvaluation, we are decreasing the carrying asset or the value, carrying asset of the asset, carrying value of the asset. Compared to the tax base, carrying value is less, so therefore there's a deductible difference, and tax component of that is deferred tax asset debit, and we credit income tax expense. So if we look at when we are looking at these examples, we're saying that parent entity and subsidiary entity are tax-paying entities, and group is not paying taxes, and we are following periodic inventory system for us to understand the general journal entries. And reversal of intergroup transaction gives rise to two events, as we talked about: reversal of the over or undervaluation, and then reversal of the gain or loss as a result of this transaction, and then the recognition of tax impact resulting from the reversal of the inventory overvaluation or undervaluation. So here's an example. The parent entity acquired 80% of shares in subsidiary. That really doesn't matter for intergroup transactions because we eliminate the amount in full. So we have a sale, and we can find out the cost based on the inventory. So there's 24 million worth of inventory that's been sold. So we can, from the profit margin on sale, we can find out the cost. we can determine the profit that the entity has made. So if you look at situation, the subsidiary made a profit of 3, the cost of inventory is 21, that's been sold to the parent entity, and it becomes cost of sales, and when it is unsold becomes inventory. And that $3 of profit is has made the inventory overvalued, and that is included in the inventory shown in the parent entity's inventory. So if we look at the general journal entries, we can see that the inventory is prepared for cost of goods sold in subsidiary, and then it was sold and made sold for 24, and that's purchased by parent and recorded there as 24, and then when it is unsold it is recorded as inventory. So when we combine the entries, the first two rows of the journal entries, we come up with debit cost of goods sold and credit sales of 24, and for the unrealized profit, debit inventory 3 and credit cost of goods sold 3. So this is the entry that we have to eliminate. These are the entries. So with debit sales 24 and credit cost of goods sold 24, and for the unrealized profit and overvaluation, we credit inventory 3 and debit cost of goods sold 3. So note that the unrealized profit is debited to cost of goods sold, as we can see from the general journal entries. Because inventory value, carrying value has decreased now, that becomes a deductible difference, and the deferred tax asset of that is 0.9, and the income tax expense is 0.9 credit. We look at inventory transacted during this period partially held, and here again the ownership percentage really doesn't matter. And on 1st of January 2014, in subsidiary sold inventory of 24 million, same example we are taking, but at the end of the year 30% of inventory is still on hand with the parents, so that means 70% has been sold out of the group where the profit has been realized. So if you look at the entry, the same entry, if 100% of inventory is still there, and again when 100% of inventory is still there, this is what the general journality will show up. And our first transaction, buying and selling, we need to reverse in full because that transaction took place. So we debit sales and credit cost of goods sold for 24. And for the unrealized profit and overvaluation, because only 30% of inventory is there, the overvaluation is limited to 30%. So 3 into 30% is 0.9, and the cost of goods sold for the unrealized profit is limited to 30%. So 3 into 30% is 0.9. The inventory carrying value has decreased by 0.9, so that's the deductible difference, and the deferred tax asset of that is 0.27, 0.9 into 30%, 0.27, and the income tax expense is 0.27. If you look at inventory transacted during previous period, the previous period inventory become cost of sales in the current period because inventory has been brought in and that it will be sold out, so it will become cost of sales in the current period. And the asset that had deferred tax asset, because now when the sale of the inventory will become income tax expense. So if you look at the example here, 80% of ownership really doesn't matter because we are eliminating the intergroup transaction in full. We give the inventory 10 million, and at a margin that has been sold, one half of the inventory is still on hand with the parent, and that has come from the previous period where the transaction has occurred. So if you look at the situation, the profit that has been made by the subsidiary is now in opening retained profit in the previous period, but we show it in opening retained profit. And the inventory that has been sold and was recorded has now become cost of goods sold. So that inventory has become cost of goods sold. So if you look at the situation in relation to general journal entries, we can see the sale and cost of goods sold are opening retained profits. So that entry is, when we summarize, become sales credit, but it is opening retained profits, and debit cost of goods sold, again opening retained profits 10 and 10. In relation to the second part of the second two rows of the general journal entries, we can see that the cost of goods sold of inventory is now 6, and the cost of goods sold on the previous period is 6. So what it means is that the cost of goods sold of the inventory and the profit is now, the inventory has become cost of goods sold, so where we have to decrease the overvaluation of the inventory by crediting it cost of goods sold, and the overvaluation of inventory and unrealized profit is in opening retained profit. So unrealized profit is in opening retained profit, so that's why there's a credit of 6, and the inventory overvaluation is in cost of goods sold, that's why there's debit 6. We're saying that this are invalid transaction that has to be reversed, and to eliminate, the first one is debit and credit opening retained profits 10 and 10. So effectively we don't need to do that, write that transaction, because it's debiting and crediting opening retained profits for the same amount. But for the second one, we debit opening retained profits for the cost of goods sold for the unrealized profit, so 3. And to decrease the overvaluation, we credit cost of goods sold, because inventory has now become cost of goods sold, credit 3. So when we take cost of goods sold, it is expenses are decreasing because it's a credit, and that means profit increase, that means income tax expense increase. So 3 into 30% is 0.9 debit income tax expense. And for the opening retained profits, where we have decreased the profit there, when we decrease profit of opening retained profits, then there should be a decrease in income tax expense of the previous period. So opening retained profits, we credit 0.9. So if you look at the summary of the current period transactions and the previous period transaction, the first one, debit sales, credit cost of goods sold. If it is from previous period transaction and we are doing the accounts, consolidation accounts in the current period, we debit and credit opening retained profits. In the current period, we debit cost of goods sold and credit inventory for the unrealized profit and overvaluation. And if the transaction occurred in the previous period and in the current period, we record it. We debit opening retained profits and credit cost of goods sold. The tax effect of that in the current period is we debit deferred tax asset for the tax component of that inventory uh, uh, credit amount, because that's the deductible amount. So we debit deferred tax asset and credit income tax expense for the tax component of that amount. So 30% of the valuation of inventory. If the transaction took place in the previous period, then we would write as debit income tax expense, because there's no asset, but in the right side we can see that expenses have decreased. That means a profit increase, so income tax expense increase. We debit income tax expense and we credit opening retained profits, because that income tax expense is now in opening retained profits.
This is the second part of our video lecture. Today we're actually going to be talking about a topic that's a little more complex than the first video we did. We're going to be talking about
intercompany sales, where we have a parent and a son, or a big company and a little company, if you want to think about it that way.
You call me big?
Yeah, well, no, definitely not calling him big. But okay,
so do you want to start with that?
Yeah, let's
Okay, so here's what we're gonna do. So we're gonna start actually with intercompany transactions, right? And by the way, this took actually me a little while to learn. Like when I was first learning it, it was kind of foreign, right? It's kind of weird topic if you think about it. So if you don't get it at first, don't worry. It comes naturally after you see a few of these problems, right? So hopefully it will make it easier for you. So here's actually how these problems are usually laid out. We have a parent, which in this case, I guess I am. Yeah. And then we have my son or daughter, but we're going to call it son because that's kind of how these problems usually go.
Parent
and son, subsidiary, exactly. So what happens here is I'm going to be selling inventory to my son. How this works in the real world is I'm a big company, parent, right? And I own little subsidiaries. So they're just basically smaller companies. And since we're all under the same umbrella, the same family, right? We're going to be selling each other inventory for the same amount as if I would sell it to a third party, right? But it still stays within the family, the inventory. So when I actually sell the inventory,
there's no actual profit.
There's no actual profit. But nothing actually changes. These entries, you guys have seen these before. When I sell inventory to Trisha, I'm going to debit cash, credit revenue, right? Because I sold inventory.
Exactly.
And then what am I going to do? Let's say if I sold the book, right? You remember, guys? Remember this book? If I sold the book, I would debit cost of goods sold, credit inventory for when I bought the book.
Exactly.
And look at the amount, right? When I sold the book, I sold it for $130. And then the cost of goods sold, which is what it cost me to make the book, was $80. So there's a profit of $50 going on, right? On the son's books...
Son, for me, well, I got a book from him, so I'm going to increase my inventory by that same amount that I paid for it. And I'm going to credit my cash because I paid it off. Then we're getting into the fact of me selling it, because he sold me something, but I'm still a company. My job is to make profit, so I'm going to sell that same thing to someone. So I get revenue for $200. I get my own revenue of $200 and my own cash from $200 from, let's say, company X.
And that company is not in our
not in our family. This is
not
we are family. That's
we're family.
Father, daughter, family. That is some other company X. And then I have to record my own cost of goods sold. And what is that cost of goods sold to me? Well, the 65 is coming from the fact that we're assuming I sold half of the inventory I have. Half of 130 is 65. So just to review, cash and revenue. This is how much I sold it to company X for, and my cost of goods sold in inventory is for the amount of what the value is to me. And to me, the value is 130, and I sold half of that, so that's 65.
Right, and it doesn't always have to be half. We just use this as an example.
It's easier, right?
It's easier, right? If you see in your problem it's 40%, you sold 40% of it, just take 40% of that, right? So it really depends. For our purposes, we're just trying to exemplify a point. It's 50%, but just know that it doesn't have to be 50%.
Yeah, exactly. So now, just on his books and on my books, this is what it looks like. But since we're a family, people look at us from the outside. When an investor or a company looks at us, they're just looking at us as one company,
right?
one
Because
family.
I own you, and you're part of me,
exactly.
right? We're family. We're
so
one.
family. So they just want to see what we all together look like. So
hence the circle.
Hence the circle. So if we were to just add your sales, my sales, your cogs, my cogs, that doesn't make sense because there's profit in there that's not actual real profit. It's unrealized.
And if this isn't making sense to you yet, just wait. We're gonna get to it.
Yeah. So just think of it conceptually. There's no actual real formula. If you think about it, there's no formula. It's just conceptual. If you realize, look, profit we made between us, that's nothing. No one from the outside is gonna think that's profit. So we have to figure out a way to make our consolidated books, our together books, come down to a number where it shows real profit that we made.
Right.
So we're gonna come here and we're gonna show you the change that we have to make in the gross profit and the change we have to make in ending inventory to get to the actual real amounts.
Perfect. So, Sun, you want to switch spots and I'll cover that?
Yeah, sure. Cover that. Okay.
Okay, so here's actually what's going on, right? The profit. So we're going to talk about the gross profit as if we never eliminated it and if we eliminated it. So check this out. So, Son, could I move you a little bit here?
Okay.
Thank you. So, revenues, right? This is the wrong way. At the moment, what kind of revenues do we have after these journal entries? Well, we're just going to look at the revenues on the parent of 130 and on the son of 200. If you sum them up, that's 330, right? That's just based on those journal entries that we already made. So check this out. The cost of goods sold now. Well, journal entry is 80 there, right? And then the sons, it's 65. 80 plus 65 is 145. The difference between 330 and 145 is 185, right? And you've seen that before. Revenues minus cost of goods sold, gross profit. 185. This is actually a wrong figure. The way it should be is as follows. So, the revenues that you can actually show as realized on the books is what you actually sold outside of the family, right? And this is what you sold, the son sold to a third party.
So that's the only real revenue.
I'm the parent, she's the son,
I sold
right?
it to X.
And she sold it to, I don't know, what's his name, Bob, right? And Bob is just her friend, but he's not in the family, so he doesn't get, we can actually realize the revenue because it's outside of the family, right? We're selling it outside the circle. So that 200, that's the only revenue that we can realize. And what's the cost of goods sold? Well, initially, it cost us $40 to make it, right?
Half of 80.
And half of the 40 that it costs us to make it, that's where that 40 comes from. Notice that it's not half of the son's inventory, right?
This is not a real cost of goods sold. That's just what you sold it to me
Exactly.
for, so I wrote it at that amount. What was the initial cost to make this product? It was 40 because, well, it was 80, but half of we sold half the inventory, so it was 40. So that's the real amount of the profit.
Right. And notice the difference between the wrong way and the right way is 25. And we'll refer to that later, that 25, and you'll see it soon. Just one more thing I want to kind of conceptually explain to you guys is why this actually happens. So think this through, like logically, right? I'm selling inventory to my son, right? And why, if we've never eliminated, imagine that I kept selling inventory all the time and my son would keep giving it back to me and I'd constantly be reselling it for a profit and inflating my inventory. And doesn't that sound too good to be true?
Yeah.
If I just kept selling you it, you gave it back to me for free, and we'd inflate our revenues to a pretty much infinite amount. That's why GAAP and IFRS, they make you eliminate the intercompany profits.
Because then companies could just lie and just make it look
Exactly.
like they have so much profit,
And
but
you
it's
know,
not even real.
And accounting, we're downers, right? We need to bring it back to conservatism.
conservative,
Conservatism,
exactly.
right?
Exactly.
So, Son, could you please talk about ending inventory?
Right. Well, for we've decided how much gross profit is overstated by, but ending inventory is overstated too. Because in our books we wrote that inventory is going to be for the amount of the beginning balance of 130 because I bought it for 130 from my dad. And I sold half of that, so that's 65. So I have in my inventory, I have an ending inventory of 65. But is that book actually worth 65? No, it's not. The actual inventory, what did it cost the first person who had it? How much did it cost him? It cost him 80. I sold half of that, so that's 40. So I actually only have $40 worth of inventory left. What's the difference of the ending inventory that's wrong and right? That's 25 difference.
And do you remember the 25 we talked about previously?
Profits also overstated by 25, and ending inventory is overstated by 25. So the right thing to do when we consolidate together as a family, we want to write down our inventory for 25, and we want to write down our profit for also 25. And how do we do that? We come to this journal entry. Writing down profit is the same thing as increasing your expenses, is it not? So you have to increase cost of goods sold by 25. That's the difference. And you have to decrease your ending inventory, aka your inventory account, by 25. Doing this journal entry, but it's not an actual journal entry, it's a work paper entry, meaning that we're just doing this for our sake to make our books look right.
So what she's saying is that this journal entry is not in the son's books, right? It's only in the accountant's books of the parent.
Yeah.
So this journal entry is never seen by the investor of the son,
No
for
one
example.
sees this. This is just for our sake, like, okay, let's see where it makes sense. Because accountants want to do what? They account for everything.
Everything.
So you can't write minus
Full
25.
disclosure.
Yeah, you can't just write minus 25. You got to show where that 25 came
And
from.
that way it's traceable, right? If you want to trace it back, the traceability of the journal entry allows for that.
Exactly. So, if once we do this entry, we officially have the correct amount of the profit, because right now profits are now 185. If we increase cost of goods sold by 25, profits down to 160. Ending inventory is written at 65. If we write down our inventory is written at 40, and then that would show that would show an outside investor the actual amount of ending inventory and profit that we have on our books, and that's what they want to see. They want to see the right number. So the concept is a little confusing, but once you understand it conceptually and see what numbers actually are the real numbers, you won't need to think of an equation or anything. You'll just need to look at the problem and say, look, what's the actual revenue and what's the actual cost of goods sold, and you'll be able to manipulate the information that you're given to get to the actual answer you want.
Perfect. And just a little more tips. Just make sure who you know you're dealing with. Make sure you know who the parent is, who the son is, because as you can tell, that's crucial to these types of problems.
Exactly.
And everything else just kind of falls into place after that. And just if you want to check yourself, you can see that the gross profit, the 25 that we got, and the ending inventory of 25, if they're the same, you know you're on the right track to do the right journal entry.
Exactly.
And I hope you found this video very helpful. Again, I'm Larry.
I'm Trisha.
And that's for you, Khan Academy.
So what are intergroup transactions? Why do we eliminate intergroup transactions? What are the consolidation journal entries done for intergroup inventory sold by one entity and held entirely by the other entity in the group? So collect your thoughts, think about it.